Okay, so today, where we had left off last week, is we were hard coding down the income statement. And really the rule of thumb for the income statement, at least in terms of revenue, is to lay it out as they've done. And the reason why I'm illustrating things this way is because what you'll see is there are some areas of the model where you just want to lay it out verbatim, meaning you want to lay things out as they have. The cash flow is a great example of that. Most of the cash flow statement, we're going to lay things out exactly as they've done. A lot of portions of the income statement, we use their income statement as a guide, but we want to move things around because there are some things that we want in our income statement, like EBITDA, that is not required by the GAAP, by government, the government general accepted accounting principle. And so as analysts, we need some information that's not always reported. So an income statement is one of those statements where you might want to move some things around. So that's, and I'm illustrating this concept now because there's one line item that I've highlighted towards the end of last class that I really want to drill into. That is a good example of that. So, just starting from the top, the revenue we do want to just lay out, costs of, and then what you often have in a set of financial reports is an expense section that's just a bunch of line items listed one after another. And although we do want to capture every single one of those line items, we do want to take a look at those line items and delineate them further. We want to separate them out primarily into two major expense segments: cost of goods sold and operating expenses. And we've done that. Here's our cost of goods sold section. We've identified one line item called, I think Amazon called it cost of sales. We're going to call it cost of goods sold. This is common. It is often that there is one cost of sales line item. Sometimes there's two or three, but you definitely want to separate it out into its own cost of goods sold section. Why? Because we want gross profit margin. Gross profit is revenue minus cost of goods sold. Gross profit is not always completely separated out in an income statement on a financial report. And then everything else is in operating expenses. And underneath that is EBITDA. Now, there are some expense line items that you might want to pull out of EBITDA. We want to start to talk about that now. So in this case, let's look specifically to Amazon's financial statements and see what they have. And their first line was cost of sales. And cost of sales, just by reading that line item, that is cost of goods sold. That's what that means. And then there are other line items that you might want to think about. Are these cost of sales line items or operating expense line items? And I had to go into the notes to read about them to make an educated guess of whether those should be in the operating expense segment or cost of sales. How do you know? Well, you have to think about, are these costs most directly related to the revenue? And the example I give, the most simple example I give, is a shampoo. I can give the example of shampoo bottles, where we said, well, a company that makes shampoo profits off of the sale of shampoo bottles. And for every shampoo bottle that you sell, what is the cost most directly related? So I don't mean salaries of employees, and I don't mean the rent of the office space. I mean the cost of the liquid shampoo to put in the bottle and the cost of the bottle. That is the cost most directly related to each sale. That's cost of goods sold. And here they say quite directly, cost of sales. Then everything else, fulfillment, technology, marketing, general administrative, other operating expense, I listed all together as operating expenses. And so if you see an other line item, you do want to think twice and say, well, should this be in our general operating expenses or not? Well, how do you know? Well, this actually specifically says other operating expense. So since it's listed specifically as operating expense, I'm going to keep it in operating expense. But sometimes it might say other items, and you have to look into it further to see whether this is actually an operating expense or not. So, for example, this other income expense down here, I don't know if you can see the hand. I'm going to highlight there. I know you see the highlight. I've seen I've seen financial reports where this line, other expense, was actually up in the operating expense section. And I had to think about, well, is this an actual operating expense, or is it just another type of expense that may not be operating? And what I'm really looking for is an expense that's extraordinary. So if you look in the book, if you look in the Walmart book, there's a section called extraordinary expenses. As an analyst, you want to remove one-time or extraordinary expenses. How do you know what line item is a one-time or extraordinary expense? So first of all, it's usually labeled as other. If it's not labeled as other, okay, a tip-off would be an expense that's happened one time. Like, so you'll see a big dollar amount in 2019, but a zero in 2018 and a zero in 2017. Then you know, okay, this is unusual. Let me look at that. That's often the case. Unfortunately, there's not an example here. Another indicator is if it's labeled other. So when I see other, I say, oh, let me think about this. But now this is other operating expense, so I know it's labeled itself as an operating expense. So I'm going to keep it at operating expenses. So if you see a line item that's rather large or different from the rest, or it happens only in 1 year, a good example is a gain on, let's say, even if it says operating, gain from acquisition. So what does that mean? So in other words, let's say this company had purchased another company, and we will potentially, if a lot of you guys stick with me, we can move on into the mergers and acquisitions course, where you'll learn when you're acquiring another company, you acquire its operations. And sometimes at the moment of acquisition, you receive a one-time gain. How do you know it's a one-time gain? By looking at a financial statement. Well, you see 2017 is zero, 2018 is zero, 2019, you see a big $40 million line item. And they say, okay, wait a minute, this just happened once. An acquisition is a one-time event. It doesn't happen every year. I guess it could in some companies, but usually. So that's an example of a line item that might be up here that you'd say, okay, well, this is not normal. Why do I want to remove things that aren't normal? Well, because as an analyst, you want a good understanding to ongoing profitability. You don't want those numbers to be swayed by line items that may not happen next year, because you want an understanding as to what the company's everyday profitability is. So you want to dig in and look at line items that are called other or that are one time and second guess them. And if they are truly one time or extraordinary, you take them out, you don't list them here, and you put them down into, you'll see here, into a non-recurring event section of the model. Now, I don't think, well, I know Walmart has some examples, so this is a good idea of why, it could be included. And somebody just mentioned that about other income, and we'll get to that in a quick second. That's exactly where I'm going. So good, perfect question to ask. But you have to think about, should this be in my gross profit number or in my EBITDA number? Because I, as an analyst, want EBITDA from everyday operations to value my company. So good example, and somebody just asked about it, is other income. This is where I'm going. So other income. So other operating expense, I'm going to keep it here. I've highlighted it because it said other, but because it says operating expense, I'm going to keep it in here. Now, other income, if you look at the annual report, right after other operating expense, they have other income. We, though, have a couple line items in between. We have EBITDA, we have depreciation and amortization, and we have EBIT. Now, we talked about last week depreciation and amortization and why they don't have it up here and why they should, or why we should pull it out. So very important to understand the structure of the income statement is revenue, cost of goods sold, other expenses, then depreciation. Their next line item is interest expense, interest income, which we've laid out, and then other income. Now, we've moved ours around. Question is why? Bigger question, the real important identifier is, should this be above EBITDA or below EBITDA? When I say EBITDA, I mean EBITDA and EBIT, okay? The difference between EBITDA and EBIT is always and only depreciation, right? So only depreciation can come between EBITDA and EBIT, but you want to really think about other income to determine whether it should be above EBITDA or below, or above EBITDA and EBIT or below EBITDA and EBIT. How do you think about that? How do you know? It depends. It depends on your analysis. And so I spoke a couple classes back about being a good analyst, and some of these questions don't have specific answers, but you as a good analyst should understand how to identify the items of question. That's a good analyst. To be a very good analyst, you want to identify line items of question and read about them and think about them and make recommendations to your boss and say, well, I think it should be above EBITDA because, or I think it should be below EBITDA because, but I wanted to check it with you. So how do you know whether it should be above EBITDA or below EBITDA? First of all, it depends on what you're doing. So, for example, if you are building a model on this company because you are looking to purchase this company, then you want to think about, well, this other income line item, if I buy this company, will this other income line item continue to be there if I purchase this company? Or if I buy this company, will this other income line item go away? How do I make that educated guess? Well, you have to understand what that other income line item is. First, let's look at what it is. So I put a little note here. I said I found it in the annual report. I had to flip through it, page 28. So if you go to the annual report, I literally had to just kind of scroll in the notes and look for it. Unfortunately, I can't control F search for whatever reason here. So I had to kind of scroll through it, and I found in page 28, well, I'm going the wrong way. They talk about it, and they specifically say, here it is, other income. Other income was the value, which we know. The primary components are related to equity securities and warrant valuations in foreign currency. Okay. So I recognize that because I'm familiar with valuing companies. You might not, but there are, if you've read a lot of financial reports, you might see line items called equity in securities or valuations of warrants. These line items might actually look familiar to me. They might look familiar to you. Here, they just generally labeled it as other income or expense. So what is this? These are investments that the company has in other companies or securities. A very, very common line item is equity in earnings of unconsolidated affiliates. I talk about this in the Walmart book. So these are investments that this company has. So that's a good clue. Now I can simply ask the question, if I were to buy this company, will I take this company's other investments? Or will this company's other investments go away? Now, sometimes you'll never know the answer. But as a good analyst, if you were to highlight this other income line item and say to your boss, I don't know if this line item should be above EBITDA or below EBITDA, but I understand that this line item is the investments this company has in other securities. So is there a way we can find out if we will be also purchasing this other company's investments? And that's when your boss might say, well, let's ask the CEO, right? And how would the CEO know? Well, it really depends on what those investments are. And the answer to the question will depend on if that company's investments will have to be liquidated upon acquisition. So it depends. So sometimes it depends on the nature of the investment. And what you'd have to do as an analyst is probably what would happen is you'd call the CEO. The CEO would say, well, let me tell you what those investments are. And then you'd have to read the notes on those investments. And sometimes there'll be clauses that you might have to call a lawyer. And this is a big deal. This is where the hundreds of hours in an analyst comes in. Then you have to go to each note, call the lawyer, and have the lawyer look at the terms of the note and say, well, sometimes there's clauses in securities that say, if there is a significant company event like a purchase or a sale, these investments must be liquidated. Then you know, okay, it's going away. So whatever the result might be, if the result is that it's going away upon acquisition, it goes under EBIT and EBITDA, meaning it gets removed from EBIT and EBITDA. I want EBIT and EBITDA to represent what I'm getting, because that's the number that I'm valuing off of, right? So that's one way to look at it. One way to answer whether this other line item should be above or below depends on if I'm buying that company. Another more common example is if you are analyzing this company just because you're valuing it maybe for comparable company analyses. So we will learn later in this class comparable company analysis. 90% of what you do as an analyst is comparable company analysis, meaning you are, let's say this company, this is the retail industry. Let's say you are required to value and build models on 5 retail companies because you're comparing them with each other. You're comparing their metrics. So the way to think about whether other income should be in above EBITDA, below EBITDA in that scenario is to simply determine, well, do those other companies have that same line item? Do those other companies that you're valuing against Amazon have the same type of equity investments? Do they have a line item that's other income from equity investments? If they all do, then maybe you want to put it above EBITDA because you're comparing them all together. If this company has it and the other companies that you're comparing against doesn't have it, then you have to pull it out because you want an EBITDA that's apples to apples, that's comparable to each other. So because now I will say that most of the time, the line item, any other income line item related to equities and securities are removed from EBIT and EBITDA because you really want to, EBITDA should truly be a measure of the company's core operations, and other side investments is not core to the company's operations. That's the simplest answer. But what I wanted to do is I want to explain to you thoroughly how to analyze any line item and how to determine whether any line item should be above EBITDA or below EBITDA. For this one, it was simple, and simply because EBIT and EBITDA should be a measure of a company's core operations, and this is non-core. So I'm pulling it out. I'm pulling it out. Now, one thing to note is I had other income above interest expense and interest income. They had it below. I want to make sure that I stress there is, and it's on slide 2. I didn't pull up the presentation today, but we can start with that next week. There is a little bit of a standard in the order in which you lay out an income statement. It's not so crucial, but it always starts with revenue. Absolutely. Cost of goods sold. Absolutely. Getting to gross profit. Then operating expenses. Absolutely. EBITDA, depreciation, EBIT. Then there's other income. It's typically other income comes here. I've seen it after interest income, interest expense, more common up here. Then there's interest. and then taxes, then net income. That's the standard. Another thing I want to point out is we ended last class talking about the signs, the pluses and minuses. For whatever reason, after operating income, sometimes companies flip the signs. I find it so confusing. So here, good example, revenue is the one exception. Revenue is shown as a positive number. There you go. That's sales. And then when you go down after revenue, every other expense is shown positive, right? And you subtract. You're subtracting from revenue. Revenue minus expenses. But for whatever reason, when you get down after interest income or after operating income, they reverse the signs. Suddenly, interest expense, and that's an expense, is in parentheses. Why? I always find that confusing, and it always causes mistakes. So I stick with the simple, consistent, every expense is a positive number. Every income is negative. That way you're always subtracting from revenue. You're subtracting expenses from revenue and you're subtracting income. Otherwise, it's easy to make mistakes. You're flipping signs, then you got to flip pluses and minuses, then you got to flip your formulas around. Very simple. So when I see other income and I see 346, here it tells you right here, the income is positive and the expense is negative. Why'd they change it? I'm going to keep it expense positive, income negative. So here's an expense 183. I'm going to make that positive 183. Here's an income 346. I'm going to make it negative 346. Same thing with interest income and interest expense. Interest income they have is 202. I'm going to make that negative 202. Interest expense, negative 848. Why? Every other expense was positive up here. I'm going to make it positive 848. And so the net interest expense and interest income is simply the sum of the two. The net is plus 646, but it's an expense, right? There's more expense than income. But this is actually an expense. So I'm subtracting EBIT. I'm subtracting down, continuing to subtract down. And don't forget to take your income before tax, your EBT, is your EBIT minus your other income minus your interest, subtracting down. And guess what? This should match. Here's your income before income taxes, 3806, 3806. The numbers match. Good. That is proof 13976. It is proof that I'm still including every number. I'm just reorganizing it as an analyst would. Okay. Now let's go down to the next line item. Income tax expense. Provision for income taxes is income tax expense. Again, for whatever reason, I listed it as a negative. It's an expense. I'm going to list it as a positive, 769. Next, 1197. Next, 2374. Those are the taxes. Oh, I forgot my margin number. Want to calculate my margin? The margin is the line item IBT divided by revenue. Okay, 2%. That's the IBT margin. Oh, look how it jumps. I wonder how it jumps. I didn't put in any margin numbers. I'm sorry. Let's go do that. EBITDA margin. EBITDA divided by revenue. 9, 12, 13. Oh yeah, it jumps. Well, it should jump here now because our depreciation's popping. EBIT margin is EBIT divided by revenue. 255. Okay. Now I want to know what my implied tax rate is. Okay. How do I know what my implied tax rate is? Well, I take the income tax expense divided by, not my revenue, my income before tax. Why? Because the taxes are calculated off of your bottom line, off of your IBT. I'm going to take income tax expense divided by income before tax. 20%. Seems low to me. Wow. Income taxes are usually around the corporate tax rate, usually around 35%. We're going to dig into that when we start to make our projections. Income from continuing operations. Subtracting down. Income before tax minus income tax expense. Okay. Now let's see what else they have. Okay, right under income taxes, they have equity method investment activity.
Like that.
Now, this is a common line item. This used to be called, or it still is sometimes called, non-controlling interest. This is a the above other income line item we talked about was the company's investments in other securities. This is the company's investments in other companies or entities. Okay. So in my book, I talk extensively about non-controlling interests. Similar to non-controlling interests. This is the company's larger investments in other entities, in other companies. And this is often reported after net income. So the company receives income from its own operations. We calculated that from above. The company also receives income in investments it has in other companies. If it owns 30% in another company, for example, it will receive 30% of its income. So we're going to look into that a little bit more, but that is an extraordinary item. So we list that as it's extraordinary because it's not core to the operations, and it's extraordinary in this case because it's after net income. So I'm going to list this, and I listed examples of non-occurring events down here. We'll talk about, but I actually listed equity method investment activity. That is it. Equity method investment activity. -4, 9, 14. -4, 9, -14. I need to think about, though, is that minus truly a minus? So that minus is actually reducing the net income. If it's reducing the net income, I want to stick with my my method of keeping it as a positive number. Positive. Negative. Positive. Okay. All right. So I'm okay. So we'll talk a little bit more about non-occurring events in the next class, but generally non-occurring events are line items that are one-time or extraordinary. Here are other examples of common non-occurring events. Discontinued operations. A company closes a business. There's a one-time gain or loss from shutting down the business. This company doesn't have that line item, so I'm going to zero it out. Extraordinary items. Extraordinary items. Effective accounting changes is a common extraordinary item. There is a new accounting law, and you have to go back and change some of your line item numbers based on that new accounting law, and that change causes a one-time gain or loss. You can identify these line items by seeing if they're repeating or not. Other, I just put other as a catch. So really, Amazon has one major non-occurring event, the equity method investment activity. Okay. And so what I'm going to do is sum all these up, even though they're mostly zero. And I don't know if I've taught you the quick hotkey for adding things in a column. Alt equals. If you hold down Alt and hit equals, boom, there goes your sum formula. Alt equals. Enter. Alt equals, quick sum, copy to the right. and then you have your net income. If you take your net income for continuing operations minus net income, that should match the net income they have there, 3033, 10073, 11588. And then we can deal with earnings per share. But this is a good place to stop because they're giving me 5 more minutes. So next week, we can finalize earnings per share. We can start making income statement projections, start talking about the cash flow statement. But this is a good, complete picture, a good example of Amazon. Key takeaways are truly how to identify EBIT, EBITDA, and extraordinary items. Right? If anybody has any questions, please let me know. I want to, again, please let me know, continue to let me know if you want to move around the schedule. This class is recorded, so you can view the recording. I'm going to email the recording now. And then let's touch base at least next Monday, maybe sooner. All right, guys, thank you for your time. See you soon.